Hi everyone, Jeff Yasteen here. By the way, make sure to subscribe to our Wealth Press YouTube channel. Follow me on Facebook and on Twitter. And tell me what you think. Just type your comments and questions in the section below. So let's talk about fuel cell stocks. It's been a high-flying sector recently, but I have an interesting play on this. It's a leading company in this sector, but I doubt you've ever heard of it. Somehow it's become the forgotten man, the under-the-radar play that no one seems to be paying attention to. Best of all, this company is profitable and it pays a dividend. And I expect the shares to rise about 50% over the next 2 years, regardless of whatever does or does not happen with the rest of the fuel cell sector. And I'll tell you the name of this stock in a moment. First, what the heck are fuel cells? If you haven't heard of this before, they work sort of like batteries. They produce electricity through an electrochemical reaction. Unlike a battery, a fuel cell doesn't run down. It doesn't need recharging from an electrical source, but it does require a fuel, in most cases, hydrogen gas. Now, fuel cells typically weigh a lot less than a battery too. For instance, the batteries in a Tesla weigh about 1,200 pounds. It's almost half a ton. The weight of an equivalent fuel cell and reinforced tank for the hydrogen is around 350 pounds, so it's a lot less. There's also recharging times. It takes 8 to 10 hours on average to recharge an electric vehicle battery. With a fuel cell, it's basically a 5-minute squirt of hydrogen right into the tank. Now, fuel cells have been around for a long time. The Apollo moon missions used fuel cells. The International Space Station uses them today. A few car companies, Toyota and Hyundai, offer fuel cell electric vehicles, although you'll find only literally a handful of them on American roads, at least for the moment. More recently, Nikola, the high-flying electric vehicle stock, claims its products, or at least some of them, may use fuel cells instead of batteries, though the company doesn't even have a production line in place yet. But where fuel cells have taken off, where growth is really happening today, and not somewhere down the road in the vague future, is in e-commerce warehouses and distribution centers owned by Amazon and Walmart and firms like that. Now, they can't use gasoline or diesel forklifts in these warehouses. The carbon monoxide would build up. It'd be a major health hazard. Now, in the past, these companies have used battery-powered forklifts, but a forklift battery can weigh up to 4,000 pounds, and it has to be basically swapped out and recharged every shift as it loses power. So warehouse companies have been starting to use and transition to fuel cell forklifts, electric forklifts powered by fuel cells. According to the U.S. Department of Energy, there were more than 20,000 fuel cell forklifts in operation. That was in 2018, and I think the number could be twice that high now. But commercializing the technology hasn't been without controversy. For whatever it's worth, Elon Musk hates fuel cell technology, calls it stupid. The companies that manufacture fuel cells, like Plug Power, Bloom Energy, Ballard Power Systems, and others, some of them have been around for many years, but have been consistently, horrendously unprofitable. As this chart shows you, Plug Power, as one example, has never posted a single year of profits in its entire existence, going back to the late 1990s as a public company. And while those losses have gotten smaller in recent years as electrified fuel cell forklifts have taken off, Wall Street analysts still expect the company to lose 30 cents a share this year, 24 cents a share next year, and 10 cents a share in 2022. That's why a stock like Plug, while popular with Robinhood speculators recently, is down 99% from where it was 20 years ago. That's right. Back in 2000, as you can see in this chart, Plug Power, at its peak of popularity, had a share price of $1,200. These days, even after the big run-up in recent months, it's a $12 stock. So, if you're speculating and you just want the juice, the action with the options and those sorts of things, I definitely get it. That's one thing. But if you're actually investing and you expect to own a stock for at least a couple of years, if not longer, you need to be far more discriminating. So I want to tell you about a forgotten fuel cell company. The name of this company is Hyster-Yale. The symbol is HY. Now, the name doesn't sound cool and techy. I get it. But Hyster-Yale is one of the top 5 largest manufacturers of forklifts and other materials handling equipment like they use in warehouses. It's been publicly traded since 2012, but the company actually can trace its corporate origins all the way back to the 1930s. Hyster-Yale generates significant, consistent profits through its sales of forklifts as well as replacement parts. And earnings per share, yes, they have been hurt by trade tensions with China in the last couple of years and COVID-19 this year. That's why the shares are down about 50% over the last 2 years. But as this chart shows, even with the ongoing challenges of COVID-19 and a disrupted global economy, Hyster-Yale still posts consistent quarterly profits. Its cash flow and profitability is such that it's paid a consistent dividend for the last 7 years. At current prices, you're getting a yield of about 3%. In other words, if you buy the stock at a recent price of $42 a share, the company sends you a quarterly cash payment of about $1.28 a share a year. That's what it totals to. So the interesting thing about Hyster-Yale is that it is a leader and pioneer in fuel cells. The company started planning for this moment in 2014 when it acquired a startup called Nuvera. Since then, they built manufacturing centers in the US, Europe, and China with a long-term plan to supply the growing market for electric forklifts powered by fuel cells. Now, in fact, they don't even call them fuel cells. The company calls them BBRs, or battery box replacements. They design the fuel cells so they can be dropped right into the same compartment where a forklift battery goes. So a warehouse operator, the companies that buy these forklifts, they don't even need to buy new forklifts to shift into fuel cell technology. They can just drop in one of these battery box replacements, a fuel cell. As the company noted in its 2019 annual report, Hyster-Yale's, quote, vision is to establish Nuvera as the preferred provider of heavy-duty fuel cell engines for zero-emissions mobility customers. Now, keep in mind, when you invest in an advanced technology, you also want to know how long it's going to take for that technology to find its way from the experimental, pilot project stage, which is where most of these are now, to being used all day, every day in the no-nonsense business world. Hyster-Yale believes its fuel cell operations are, quote, approaching the point where it will move from being a venture business focused on commercializing fuel cells to a product-based company serving not only the forklift market, but also buses, trucks, and automobiles with an expanding line of products. In other words, fuel cell technology is growing up. It's a real thing, and it's about to get a whole lot bigger, in my opinion. Now, how much bigger? Well, earlier this year, one market research firm said it expects the global market for electric buses alone, these are electric buses of all kinds, to rise from 136,000 units in operation last year to more than 900,000 vehicles in operation by 2027. Now, that's a compounded annual growth rate of more than 27% a year. That means it's basically doubling every 3.5 years or so. But for that to happen, heavy vehicles, like electric buses, need to overcome one severe limitation: the durability of their battery charge. Now, those batteries do well enough in flat areas. They last 2 to 3 hours. But in cities with lots of hills, combined with the stopping and starting of the bus as it picks up passengers, well, it quickly bleeds a bus battery, of most of its electric power. And then it has to be swapped out. Big deal, you say. Well, have you seen the robotic systems that are needed to quickly swap out a bus battery, so it doesn't have to go back to the depot and use up lots and lots of time? As this video shows, those systems are huge, and they have to be retrofitted to a bus station or a bus terminal. And of course, that adds a lot more cost and a lot more complexity and helps make electric buses pretty much impractical. That's why most US cities are really only experimenting with electric buses. They haven't bought them in really large numbers, in terms of their fleets. The only place where you find them in large numbers is in China, where the government has dictated their use regardless of the cost. So here's where fuel cells come in. From a practical standpoint, it's a lot easier to fill up an electric bus or an electric truck with a shot of hydrogen to its fuel cell, the same way buses' fossil fuel engines today are refueled with natural gas or diesel. So that's the promise of owning a fuel cell stock. But the best part of owning a company like Hyster-Yale is that it is historically profitable and generates lots of cash flow. So, unlike most other fuel cell companies, it doesn't need to sell more and more stock to raise cash. If you don't believe me, let's compare Hyster-Yale to Plug Power. The red bars in this chart show us Plug Power's shares outstanding. In other words, how much stock is floating around in the market available for purchase by you, me, and Wall Street institutions. In 2013, Plug Power had 50 million shares outstanding. These days, it has 5 times as much, about 250 million shares. So that's like taking a pizza and cutting it into smaller and smaller slices as the years go by. And what happens? Each slice becomes worth less and less. By comparison, Hyster-Yale has the same number of outstanding shares today, about 16.5 million, that it did in 2013. So shareholders don't see their ownership stakes diluted or watered down. The company generates plenty of cash flow, so much that it can pay a 3% dividend to its shareholders and still have enough money left over to spend another $50 million a year on capital expenditures to build its fuel cell business and other projects for future growth. That's what I like about Hyster-Yale. It's not sexy, but you know what? I'll take consistent profits and a steady dividend over sexy and long-term unprofitability any day of the week. Now, according to Wall Street analysts, the company, Hyster-Yale, is on track to earn about $1.57 a share this year and $2.25 a share next year in profits. Now, on that basis alone, I expect the stock to rise by about 50% over the next 18 months to 2 years. As the U.S. and global economy recovers, I expect even larger profits in the years beyond. Now, that buys plenty of time for fuel cells and the so-called hydrogen economy to become a much larger mix of the U.S. transportation market. As that happens, Hyster-Yale and its shareholders will be ideally positioned to benefit long-term with both their shares and plenty of profits in those shares in the years to come. If you like what I'm talking about, make sure to continue to follow us, subscribe to us on YouTube, follow me on social media, and until next time, I'm Jeff Yasteen.